Welcome to the Newsio podcast. Today, we're looking at a headline that sounds like a clean turning point, but rarely is: Venezuela's stock market surge. Reports describe an extraordinary rally in Caracas, and whenever a market explodes upward, the public question is immediate. Does this mean the economy is finally on track? Here is the disciplined answer: not automatically. A stock market is a pricing engine for a limited set of assets. It can move fast, far faster than real-life changes for households, workers, and businesses. So, in this episode, we'll do three things. 1. Explain what can drive a sudden surge. 2. Separate market signals from economic reality. 3. Give you a simple checklist of what to watch next so you can judge whether this is a durable shift or a short-lived spike. Section 1. What likely drove the rally? First, expectations. Markets trade the future, not the past. When investors believe political conditions could shift or external constraints could ease, prices can re-rate quickly, especially if valuations were deeply depressed. Second, liquidity. In smaller or constrained markets, trading can be thin. That matters because when volume is limited, even modest buying pressure can lift prices sharply. A dramatic chart can reflect a narrow flow of trades, not broad confidence. Third, currency dynamics. In economies with instability and complex exchange rate realities, headline gains can be hard to interpret. Prices can rise in local terms while purchasing power remains fragile. Even dollar gains can be shaped by how conversion works in practice. Put these together and you get a powerful mix: new expectations, thin liquidity, and a highly sensitive environment where prices can move quickly. Section 2. What this surge does not prove. It does not prove that inflation is under control. It does not prove the financial system is fully functional. It does not prove that rules, contracts, and property protections are stable. And it does not prove that ordinary people will feel relief in wages, prices, or services anytime soon. Markets can surge on hope. Economies recover on institutions and execution. So, what should you watch next if you want a realistic picture? Signal 1. Breadth and volume. Are more stocks participating with consistent trading, or is the move concentrated in a few names with thin volume? Signal 2. Currency and inflation direction. Is there greater stability or more volatility? In fragile environments, currency instability can erase headline gains fast. Signal 3. Policy clarity and rule of law credibility. Do investors and businesses get predictable rules, or do the rules shift with political pressure? Signal 4. External constraints, especially sanctions and trade channels. In Venezuela's case, external access and energy flows can strongly influence the macro outlook. Signal 5. Real economy evidence. Do supply conditions improve? Are prices stabilizing? Is there measurable relief for households? Because a market can rally without improving daily life, and daily life is the real test. So if these signals strengthen, a rally can evolve into something more durable. If they do not, the same forces that pushed prices up can pull them back down. Here's the takeaway you can use immediately. Do not treat a soaring stock index as proof of national recovery. Treat it as a snapshot of expectations, often amplified by liquidity constraints and uncertainty. And when you hear confident claims like, "This guarantees a strong economic future," pause. Ask the smarter question: what changed in institutions, rules, currency stability, and external access? Because that is where lasting recovery is built. Venezuela's market surge is a real market event, but whether it becomes a real economic turning point will be decided over months, not days, by stability, governance, and the conditions people actually live in. This was the Newsio podcast. If you want, I can turn this into a one-page watch list you can revisit weekly, so you can track what's real, what's hype, and what's still uncertain.